Welcome to Insights. I'm Eric. Thanks for joining us again this weekend. We're going to talk about wheat today in terms of a question that I received. Someone had talked about, in an email how their TA and their work was suggesting that wheat was looking halfway decent over the short term, and how could this setup be considering some of the things that we're reading inside the matrix in terms of both energy and some of the cycles. And these are a good question. I mean, that's an excellent question. Shorter term can often disconnect with some of the things that show up in the evolution of the trade. So I'm going to introduce concepts of what the evolution of the trade is all about in terms of establishing what the composite trend is. The composite trend is a menu of probabilities and understanding what those probabilities tell us, as well as the opportunity cost of every decision that we make inside the matrix. So if we take a look at the idea, the question is how can wheat trade higher? And not too long ago, I talked about how wheat was at least looking like it's jumping the creek. It didn't seem to hold that. We are now consolidating. The daily trend is down. The weekly trend and monthly trends are up. But you can see by the colorations here that some of these cycles, and this is the price cycle, and BUS is price, BUST, or for T is for time. These are the price and time cycles. In terms of the normal matrix, they're 2.5 and 2.19. That's through year 2000. If I extend the database, and I don't do this for every asset inside the matrix, just for the data requirements and the computing cycles that are required to do this, we have to keep the matrix fast and timely, and considering the computer equipment that I have, there's certain shortcuts that we want to take. But if we expand the database, and I'm going to pull it up here quickly, here's wheat back to 1959. This is from a larger database. I pulled it into a separate feed here so we could talk about it, at least with this program. We can see that the price cycle, instead of above 2 standard deviation, is 0.6. There's 84 bull impulses, there's 84 bear impulses, and the average 17 weeks, so 53, 54 weeks is about 2.3, 2.4 standard deviations. That's a little bit different in terms of, well, not too different in time. It actually is higher, but it's different in terms of the price. The current impulse, which is 28%, and that's what BU is over here, that's only 0.6, and that's because we have a much higher weekly impulse. The highest recorded weekly impulse was 162%, and so 28% is kind of peanuts in comparison to that, and that's what the computer is saying. So we're going to head back to the matrix here quick. If we take a look and superimpose the longer cycle, the bigger database, these cycles shift downwards, so it's 0.6 and 0.23. So this opens the door to the possibility that continuation of the uptrend, in particular the weekly upcycle, is still a possibility. But how realistic is it, considering that whether it's the shorter database at 2.19 or it's the longer database since 1959 up to 2.34, what is that exactly telling us? Well, in terms of probabilities, any probability that's above 2 suggests that we're above 95% of the previous observation, either in terms of that 28% or in terms of the 53 or 54 weeks, whichever one you're looking at. Anything above 2, if we're getting close to 3, it's like 99% of the observations are lower than the current score. So in terms of time, we're either here or we're about here. And so that means we're anywhere between 95 and about 97.5% of all observations. So it's really, what it's saying is that the computer's telling us there's probably one instance where the price cycle pushed above 54 or 53, 54 weeks, and I think it was 67 weeks, which was the maximum. But the question then becomes is, okay, to push this from here to there, what is it going to mean in terms of the cycle score? And probably to get from 53 weeks to 67 weeks, this is going to have to go to 3 standard deviations, and this one's certainly going to have to go above that. What are the odds of doing that? Well, the only basic analogy that I would like to, or maybe a description of the setup, is that when you first start the cycle in the negative territory and you want to push it towards these regions here, it takes very little energy to go from here to here. and it takes a little bit more energy to go from here to here and go to here to here. But when you get into the tails, and you're say we're at 2 standard deviations and we want to push to 3 or 4, it requires an increase. This function clearly is nonlinear. It takes on the appearance of a linear line here or here, but as we get up here, it's got a curvature, and it definitely has a curvature here, which tells you that this is an exponential or high order function of some degree. You can actually do the mathematics behind it. When you want to push a cycle from 2 to 3, it requires significantly more energy to do that here than it does to move from here to here, or from here to here, or from here to here. And that's where the concerns lie. The assumptions that we can take price higher, which I've seen a lot of things happen in the matrix over the years. I wouldn't even rule it out. I mean, the fact is wheat does look okay over the shorter term, but it's not a good probability setup to push this, to get this higher, to push this up from 0.6 standard deviations to, say, I don't know, let's get it up to 2. It's going to require a fair amount of energy to do that. And the fact is trends are not just a function of time, and they're not just a function of price. They're a function of both price and time cycles simultaneously, and that's what this chart is supposed to be referring to. The fact that inside the daily trend or the tertiary trend, there's 2 cycles that are working together. This one is the time cycle up and down, works on the X and the Y, but the price cycle is working off of a Z. It's moving out here and it's moving in and out. Either one of these can destabilize not only the daily trend, and this exists both, this double cycle or dual cycle exists both on the secondary and primary trend as well. So there's 3 trends we're studying. There's 2 cycles in each one of them. Yeah, you're dealing with six components of a composite trend, which then, remember, these come in and these line up here, and then this moves in and lines up here. And then you've got the price component that's here. We can't see it. The fact is that we have a lot of components. Any one of these cycles, whether it be price or time, is going to destabilize both not only the individual trend, but as well as the composite trend. This is why the composite trend is out of alignment. It's really because of these cycles and this cycle right here. Regardless of whether we're using the long or short database, the time cycle is clearly extended. I mean, it's becoming painfully obvious. 53 weeks, if you're looking ahead in 54 weeks, it's just extended. You're pushing the limit, and that's what the computer is warning us. Now, you're pushing the limit even as the energy build is negative. I mean, the energy builds don't take priority here. It's these cycles that are taking the priority. But the fact that expecting a short-term rally under an energy build like this, that doesn't help the cause either. So the fact is that composite trends or setups within the matrix are basically probability setups. You're trying to follow the primary trend, and the primary trend's here and it's still up, and you want to maintain your core position as best as you can. But the idea that we've seen a downward action and we look like we want to turn here, well, first we got to get the downtrend and the daily back up. And then if it goes back up without influencing the weekly and resetting the weekly time frame, you're going to be dealing with cycles that are just going to be getting bigger and bigger with each passing week. The more that these cycles, the bigger these numbers go, the more difficult it is to push the weekly cycle higher. But the weekly cycle doesn't exist outside the daily cycle, and the daily cycle doesn't exist out the monthly cycle, and they're all inside of each other's cycles as well. So the fact that the weekly is sitting out here screaming, my God, I can't lift this thing any further, or it's going to be difficult to do it, it makes us weary about chasing this with fresh money. Can the short term go up? Yeah, it can. I've seen some weird things. In the long run, if you did this for 10, 20 years and you saw these types of setups and you kept chasing these, I refer this as you keep forcing a bad position. Is it going to come back and bite you? Yeah, it'll come back and bite you more times than you're surprised that it didn't. The fact is the cost of pushing or forcing this position is pretty high due to these cycles, the energy build, the whole setup, the composite trends out of alignment. I mean, there's a lot of things that are wrong with this right now that would all have to correct. And the last concept that I want to bring apart is that the opportunity cost of forcing a bad position in wheat is relatively high. It may not seem like it's high because you're looking at wheat and maybe that's the market you trade and you think, well, that's all I know. But the fact is, and I left Bitcoin in here to compare it with, there's other opportunities that don't have the probability based difficulties that wheat has. And essentially, the probabilities of the setup in wheat are much better than the setup for Bitcoin are much better than the setup in wheat. So if we take a look at this, Bitcoin's triple up, still triple up. It's been up. It realigned 30 days ago, and we've actually, the computer has flagged a halfway decent trade shorter term. But the fact is that that could easily continue because the composite cycle score is a minus zero point 0.3, which is still well below normal. Anything below zero is still early. That's why the computer calls it early. So there's a little bit of extension here. There's no extension on the weekly time frame, and there's no extension on the monthly time frame. It's a much earlier setup. And you throw in energy, well, DI was much higher than this a month ago. We had talked about that, and we were screaming about that when everybody was bearish on Bitcoin. But then when the primary trend and everything went back to triple alignment, this energy build has started to release itself. So it's no longer near 100, it's falling down. But DI2, which is the longer term trend, is still bullish at 31, whereas the DI2 for wheat is minus 27. That's a totally different energy build. This has a bearish bias, where this still has a bullish bias. There's a lot more energy here to be released in order to send the price higher, where here has much less. Again, this is not driven by energy. Energy doesn't make decisions. It can push things around short term, but energy can be overridden by the composite trend or by cycles. So we're focusing on the cycles. That's what defines the overall probabilities for wheat right now. And as a comparison, Bitcoin's probabilities are much better, which means that there's an opportunity cost, and a high one at that, for forcing a position in wheat when you could be, let's say, let's put $1,000 into wheat to keep it easy and simple to think about. Well, that $1,000 that could be allocated to Bitcoin is probably better, because Bitcoin is in triple alignment still in its early cycle, and even if this thing flipped back up to triple alignment and say the daily turn back up, I seriously doubt the composite score would be an early cycle. It'd probably be mid if we're lucky, and it might even be closer to late. It might even flip into late, which then the computer would be saying, don't play there. I mean, stay away from that. So in terms of this, the shorter term in terms of wheat, yes, it can look bullish. It can compel us to think everything's okay, but the reality is the composite trend is much more than just a price cycle. It's time cycles, and it exists on an infinite number of time frames. We only use 3 of them because we don't want things to get too complicated. I know that you lay out the fact that there's quarterly and maybe even 30-minute charts and other things, that it can get quite complicated. A computer can handle all that, but I found that 3 times frames is just about enough for the average trader and the average investor. But the fact is there's many cycles in play here, and wheat has got a lot of work to do, to say the least. So really, the setup for wheat can be short term. Yes, wheat could continue to go higher. The path of least resistance is up. It stays that way as long as the monthly trend is up or doesn't get old. But this thing is, I could say the same thing about Bitcoin. The fact is Bitcoin's opportunity cost is, or the opportunity cost of forcing wheat is pretty high, because plays like Bitcoin, and natural gas is another one, where if you look at it, natural gas setup is far more favorable than wheat is. You'd be better off allocating fresh money in that area than forcing a position in wheat and just waiting for the invisible hand to take care of these cycle scores here. Come back, I don't know, whatever it takes, a month later, 2 months later, whatever the time it takes to reset that and readdress it at that point. But it is a concept that is difficult, and people don't focus on the multitudes of the number of assets inside the matrix that we have here. There's over 40 of them, and most people don't trade that many. And I never did. I only did that once I had the computer on my side. Then the computer started acting like a robust research team, and then I was able to allocate my money between good opportunities, which are high probability opportunities relative to low probability opportunities. And the fact is whatever's happening shorter term, wheat remains a low probability score because of just these time cycles and price cycles right here. So basically, that's the setup for all assets in the matrix. We talked about specifically about wheat. This could be applied to almost anything. We also just focused on Bitcoin, but again, there's numerous other plays that have better setups. I just can't talk about them all. It's really the concepts. What are we talking about? We're talking about understanding the composite trend. There's the price and there's the time cycle within the composite trend. When the composite trend falls out of alignment, we go into cause or consolidation that looks like this. It can be shorter term, it can be longer term. When the composite trend aligns across multiple time frames, 2, 3 of them, you get markup or you get marked down, and that's where you make the most amount of money. You make the most amount of money by following the composite trend. The composite trend is either up or it's either down. But that's also influenced by energy and things we talk about all the time. But really, what we're trying to talk about here is the cycles and the cycle scores and the probabilities of continuation, or if you have a very low probability event of pushing wheat from 53 weeks to 60 weeks, then you have a high probability event that wheat will enter cause building. It's the flip side of it. If you have a difficulty of doing something of maintain the existing state, the other state would be cause building, which means is you have a trend that falls out of alignment. So the play in wheat is the highest probability for wheat is for it to push into cause building at some point, just due to these cycles alone. And the fact that Bitcoin's a better opportunity because it doesn't have any of those cycle extremes to force it out of alignment that we see right now, which is triple up. If you have any questions about anything we talked about here, we just talked specifically about wheat, but it really can apply to any market. Just let us know. Contact us at the blog, or leave some comments under the video. I'll try and leave this open because this is an important concept and question for every market that trades inside the matrix. So other than that, I want you to take the time, read this over, think it over, enjoy the remainder of the holiday weekend, and try and take a break from the markets. We're going to be firing up, I'm sure, first thing on Tuesday morning. So when it does, hopefully this type of discussion will bring a better understanding of all the markets that you do track. So thanks for watching and enjoy the rest of your holiday weekend.